The last thing you want to do is be surprised in retirement. And here to talk with me about that is Joe Stenken from Ameritas. Joe recently wrote an article for Retirement Daily about this subject. And Joe, welcome. We're eager to have you walk us through the article you wrote for Retirement Daily.
Thank you, Bob. Yeah, thanks for having me on. And yeah, I think a lot of people are even surprised that their Social Security benefits are taxable. And in addition, they might even be more surprised, especially if they're have a little bit of ways before retirement, that actually part of the Medicare benefit that they receive when they retire is something they actually have to pay for. And so I think two of those things are something that's a surprise. Or could be a surprise if you're not expecting it. And the thresholds, especially for Social Security taxation, are low. The main reason is that those thresholds, which are just $25,000 of income for a single individual and $32,000 for a married couple filing jointly, those were in the early 90s, and they have not been indexed for inflation, as you know, and probably a lot of your readers or a lot of our watchers know. Most of the tax numbers are updated every year, but those tax numbers for Social Security benefit taxation have not been updated since 1993, and as far as I know, there's no plan to update them in the future. And even a bigger potential tax, if you will, although it's not technically a tax, it's really an increased premium amount, is Medicare Part B, which for those that are not experts in Medicare Part B generally pays for doctor visits and other services related to doctor visits. Medicare, or the Centers for Medicare and Medicaid Services, set those premium amounts. Those are adjusted every year, unlike the Social Security taxation thresholds. But those are set in general so that individuals pay about a quarter or 25% of the total cost of that particular program. However, Congress a number of years ago decided that they would means test that or increase the premiums based on an individual or a couple's income. Now, those don't affect as many people as the Social Security taxation, but they can certainly be a big hit for, especially if they're not expecting it. If they have a big income hit, if, for example, they sell a business, or maybe they take out a large amount from their IRA or qualified plan in retirement to pay, for example, maybe to help out a child or a grandchild pay for college, or even something like a medical emergency, or maybe they just take money out to maybe buy an RV or something like that. I was watching something recently about a lot of people buying RVs to get away from things, especially during this whole COVID situation. So if somebody's income is higher than what Congress has said is needed for, then they'll be hit with this higher Medicare Part B premium, which could be as much as $400 a month or more for an individual, and then that's double for a married couple. And so then the question becomes, well, what can somebody do about that? And like I said, there's a lot of planning that might be involved, especially for somebody who's got a few years until retirement. They might be able to plan for this better than maybe if they're already in retirement. So one thing they can do is, if they do have qualified plans or IRAs, they could potentially take money out before retirement. If you take money out after 59 and a half, that's not subject to the penalty, the 10% penalty. Now, the person probably wants to run their numbers and see what that would look like, from taking that money out into retirement, because if they take money out early, there's obviously going to be taxation. They might still be working at that time, and so they might be in a higher bracket. But it's certainly something to look at, is to take that money out earlier, even rather than later, even though that might seem kind of counterintuitive. Another thing that can be done, again, this would be planning, before retirement, is instead of having money in a traditional IRA, put money in a Roth IRA. Roth IRAs are, if money is taken out properly, they're not subject to income tax, and so they're not also subject to counting for against increased Part B premiums, and they wouldn't be accounted for taxation of Social Security benefits as well. Another possibility is purchasing permanent life insurance. Life insurance, if money is taken out properly, again, it's not counted as taxable income. And if that permanent life policy is held to a death benefit, it'll never be, again, if taken out properly, it'll never be taxed. Mm-hmm. And then another possibility is if somebody's not insurable, is they could use a deferred annuity, a non-qualified deferred annuity. Now, those are subject to tax when money is actually finally taken out. But unlike a lot of vehicles such as CDs or even brokerage accounts, it's possible to time taking the money out of a deferred annuity so that it's taxed when you want it to be taxed instead of maybe unexpectedly. If you're having a low tax year, if an individual's having a low tax year, they could take money out then. If they're having a greater amount of income in a certain year, they could put off taking money out of that deferred annuity until later. And so those are kind of the big items of planning, Bob, that could be done to try to avoid, again, taxation on Social Security benefits, or at least minimize those the taxation, and also to minimize the hit of higher Part B premiums.
All right. Joe, I want to thank you for sharing your knowledge and wisdom about this topic. Much appreciated.
Thank you, Bob. Happy to help.